Hello students, in today's lecture we are continuing with our topic option trading strategies, and in this particular lecture we are going to discuss about two option trading strategies, that is strips and straps. And strips and straps, in order to understand the concept of strips and straps, we can refer to the previous option trading strategies like straddles also. In straddles also we have seen that the combinations of option strategies are used, and the combinations of call and put options basically offer many strategies for the investors, those who want to hedge the risk of their portfolios. And such strategies which are made with a combination of call and put options, they are like straddles, strips, and straps. Straddles we have already discussed in the previous lectures, and now in this lecture we are focusing on strips and straps. Basically, this technique, the strips and straps, can be considered as the variations of the saddle technique. First, we take the concept of strips. A strip strategy is buying two at the money put options and one at the money call option of the same strike price, expiry date, and underlying asset. Yani for one underlying asset with same strike price and same expiry date, we will include three options in our contract, two buying and one for two as a put options, that is two for selling, and one for buying, that is one as a call option. In straddle, already we have discussed that one call option and one put option is taken. Here in this strategy, that is strips, since we are buying two at the money put options and we are buying one at the money call option, therefore it can be described as adding a put option to a straddle. Straddle में put option add हो गई है. This option strategy is used by the investor when he is bearish on the market. When we say bearish, it means when the investor expects a decrease in the prices in the future. Those investors who expect a decrease in the prices in the future, those who think that market will come down and prices will come down, prices will fall, that is known as the bearish trend and bearish investors. And investors pursuing a strip strategy believe that the stock price is more likely to decrease, fall than to increase. Strips. This strategy will make profits if the prices move downward. Since already this is a bearish strategy and the investor is of the view that prices will come down, therefore this strategy makes profit when the price moves in the desired direction, that is when price move in the downward direction. In strip option, there will be unlimited profit if the price of the underlying asset moves in the upward direction, and limited profit potential on downward price movement, but the risk, that is loss, is limited to the total premium paid for buying the options plus brokerage and commission. Now we take on straps. A strap is an option strategy that involves the purchase of two call options and one put options. It means it is opposite to the strip, with the same expiration date and same strike price for the same underlying asset also. So it can be considered as adding a call option to a straddle. Straddle में call option add हो गई है, and this option strategy is used by the investor when he is bullish in the market. That is when he expects that price will move upward in the market. Opposite of strips, investors pursuing a strap strategy believe that the stock price will more likely increase than decrease, because he is a bullish investor and he is behaving like a bull. Therefore, he is expecting that the stock price will increase. And for this reason, straps involves two call options that will double the profit from any increases in the prices of the stocks. And if we make a comparison of steps, straps and straddles, since it is already clear from the previous discussion that the step and straps are the strategies which add a call option or put option to the straddles. The steps and straps are even more difficult to profit from the straddles since they involve an additional option. This is the difference. That is, in straddle there is only one call and put option. Here either put option has increased by one or the call option has increased by one. Therefore, it will be more difficult to make profits as compared to straddles. And one thing which is worth noting here, it is the investor should be optimistic. That is, if the investor is taking the step option on the basis of that he is behaving like a bear and he will think that market will move in bearish trend, and in case of straps he is behaving like a bull and he is expecting that market will behave like a bullish market, then if the price moves in the desired direction, then these strategies can be quite rewarding. That is, these strategies will give profit to the investor only when the price obviously moves in the rightward direction or in the desired direction. Thank you.